All right, welcome to The Explainer. Today, we're going to peel back the layers on something pretty fundamental to any company's finances, how they account for their biggest physical assets. And trust me, it's about way more than just the price tag.
So here's how we're going to tackle this. First, we'll look at the big picture of a company's major assets. Then we'll see how accountants sort them out, dig into the official rulebook, and then the fun part, we'll put it all to the test with a real-world calculation and see what the final tally looks like.
First up, let's talk about the very foundation of a company's operations. We're talking about the big stuff, the non-current assets. Think buildings, heavy machinery, basically anything that's going to stick around for more than a year and is key to actually doing business. But here's the thing about accountants. They love specifics. They don't just throw all these long-term assets into one big box. Nope, they slice and dice them, starting with one really major split. That first split is between what you can physically touch, the tangible assets, and what you can't, things like brand value or software patents. Those are intangible. They each have their own set of rules, but for us, today, it's all about the stuff you can physically kick. Okay, but we can slice this even thinner, and it all comes down to why the company owns it, the purpose. So think about a building. If a company uses it to make widgets, that's property, plant, and equipment, or PPE. But if they own that exact same building just to rent it out and collect checks, that's called an investment property. Totally different category. And that distinction is absolutely crucial. It brings us right to our main event today, PPE, which lives under the rulebook known as IAS 16. All right, so we know what PPE is, but hold on. A company can't just buy a new machine and slop it on the books. It's got to pass two really strict tests before it's officially recognized as an asset. So let's just hammer this definition home one more time. These are physical, long-term items the company is actively using right now in its own operations to make money. Not sitting in a warehouse, not being rented out, but working. And here they are, the two big questions. First, is this thing probably going to make us money in the future? And second, do we know exactly what it cost? If it's a yes and a yes, then boom, it's official. It gets on the financial statements. Okay, this brings us to the absolute heart of the matter, and this is where it gets really interesting. Because figuring out that cost, well, it's way more complicated than you think. It is not just the number on the invoice. Honestly, the best analogy is buying a house. The listed price is never what you actually pay, right? You've got legal fees, inspections, taxes, all these things get bundled in. Well, the exact same logic applies to a company's huge assets. So here's the rule. You have to include every single cost that was necessary to get that asset to where it needs to be, in the condition it needs to be in, to start working. This includes the purchase price, delivery, installation, even architect's fees. And this is the part that blows most people's minds. You even have to include an estimate for taking it all apart at the end of its life, years from now. Wild, right? Now, just as important is knowing what you can't include. So things like your general office overhead, the cost of the big launch party for the new factory, or even any money the company loses in the first few weeks of getting the machine up to speed, all of that is a no-go. That's just a regular expense. It doesn't get added to the asset's value. Okay, enough theory. Let's make this real. We're going to walk through a calculation step by step to see how this all shakes out in the real world. So, say a company buys a shiny new piece of production equipment. The invoice says $250,000, but we're way smarter than that now, right? We know that's just the beginning of the story.
Okay, step one. You got to get the machine to the factory, right? That's $18,000 for delivery. So we add that to the purchase price, and our new total is $268,000.
Next up, it's not going to install itself. That costs another $24,000. Since you can't use it without installing it, that's a direct cost. We add it in. We're now at $292,000. Then there's another $21,000 in miscellaneous costs, maybe some architect's fees or getting the site ready. Since those were essential to get the machine running, we have to include them, add them in. Our total just jumped to $313,000. And here comes that curveball we talked about. The company figures that way down the road, it's going to cost about $12,000 to take this thing apart and clean up the site. And the rulebook, IAS 16, says you have to account for that cost today. So we add that in. And it brings us to our final true recognized cost, $325,000. So let's just put that all together. You can see the 5 costs we included: purchase price, delivery, installation,
other direct costs, and that future dismantling estimate. And look what's not there, the general admin costs and those early operating losses. We ignored them, just like the rules say, which is how we landed on that final number.
Okay, so after all that math, we have our number, our true cost. But so what? Why did we go through all that trouble? Why does this level of nitty-gritty detail actually matter? Well, that final number, $325,000, that's what gets recorded on the company's balance sheet. Think about it, that's $75,000 more than the price on the invoice. That's a 30% jump. And this isn't just some accounting game, it has real consequences. That bigger number becomes the starting point for calculating depreciation, which hits the company's profits for years and years to come. At the end of the day, this is all about giving a true and fair picture. It helps investors, and hey, even the company's own managers, understand the real investment that's being made. Sure, a bigger asset number might look impressive on the balance sheet, but it comes with a price. Bigger depreciation expenses later on. It's a fundamental measure of how well a company is investing its cash to grow in the future. So the next time you read that a company's making some huge purchase, you'll know there's more to the story. You'll be thinking, what are the hidden costs? And that is your explainer on the real cost of property, plant, and equipment. Thanks so much for tuning in.